In this module, we shall discuss about benefit and ability to pay approaches. We shall start with the principle of equity in taxation. The principal question in taxation which arises is what kind of tax system should be applicable in an economy, just or equitable? Equity in taxation is the first canon on which Adam Smith laid emphasis on. Not only pure economics but also in social philosophy tax system, choice is a major issue. There are two basic theories to devise a fair or equitable tax system, namely, first, benefits received theory and second, ability to pay theory. After studying this module, you would be able to know the various taxation approaches prevalent in Indian public finance, learn the principle of equity in taxation, analyze the barometers used to compute the taxable burden of an individual, know the meaning of horizontal and vertical equity, evaluate the relationship between tax liability and benefit received by an individual, evaluate the relationship between tax liability and ability to pay of an individual. Moving on to the ability to pay approach. The ability to pay principle states that the taxes should be levied on the basis of the ability to pay of an individual. In other words, those having higher income must be levied with higher taxes as their ability to pay is more, while the lower income level individuals must be levied with lower taxes as their capacity to pay is less. Taxes are a means of shifting the purchasing power of income to governments, and hence the ability to pay is based on income. Those who have higher income can afford to pay more tax, that is, they have a greater ability to pay. The ability to pay has two major criteria. First, horizontal equity. Horizontal equity principle states that people earning the same irrespective of their position or status must pay the same. For example, Mr. A, junior executive of X company, is paying tax 5,000, that is 10% on his salary of rupees 50,000. Then the clerk of some other company who is also earning the same 50,000 bucks must pay 5,000 bucks as tax, as his ability to pay is the same even though his position is a bit lower in the company. Second, vertical equity. Vertical equity states that the payment of taxes should be dependent on the level of income earned, that is the ability to pay. In other words, different people with different ability to pay must pay differently. For example, Mr. A earns 50,000 bucks and pays 5,000 at 10% on his salary as tax. Then Mr. B, who is earning 5,000 bucks, must pay 500 bucks as tax at same 10% on his salary. Next, we shall discuss the approaches to the measurement of ability to pay. Subjective approach. Subjective approach to tax paying ability states sacrifice as the decisive factor for determining the tax burden. Every time a tax is levied on an individual, he feels a pinch or suffers from a disutility. That pinch or degree of disutility is the amount of sacrifice by the individual, and he must be made responsible for the same. Therefore, under subjective approach, the tax burden is defined by the amount of sacrifice made by the taxpayers. Here, three principles of sacrifice have been given, which are later explained in detail for reference. First, the principle of equal absolute sacrifice. Second, the principle of equal proportional sacrifice. Third, the principle of equal marginal sacrifice, minimum aggregate sacrifice. First, the principle of equal absolute sacrifice. The principle of equal absolute sacrifices states that the tax levied with regards to the utility sacrificed must be same for all taxpayers. The principle of equal absolute sacrifice requires u is a function of y minus u in bracket y minus t should be the same for every individual, where u stands for total utility, y states the income, t states the amount of tax. Uy states the total utility at a stated income y. Uy minus t states the total utility of post-tax income. Second, the principle of equal proportionate sacrifice. The principle of equal proportionate sacrifice states that every individual should be levied with the amount of tax that the sacrifice of utility as a proportion of his income is the same for all taxpayers. The principle of equal proportionate sacrifice requires Uy minus Uy minus t upon Uy should be same for all taxpayers. That is to say, an individual with higher income is levied with the same proportion of sacrifice even with the given falling marginal utility of income. He is required to pay tax at higher rate. Therefore, it is also known as progressive income tax. Third, the principle of equal marginal sacrifice. The principle of equal marginal sacrifice states that the tax burden must be levied in such a manner that the marginal sacrifice of utility of each and every person paying the tax could be the same. This way, the aggregate sacrifice of the society as a whole can be minimized. If we try to elaborate this, we can see if all people pay that much tax that their marginal sacrifice of utility is the same, the loss of total utility by the society will be the minimum. Hence, this approach looks at the problem of distributing the tax burden efficiently for the better results in the society as a whole. As per its nature, when the marginal utility of income falls, this principle of equality of marginal sacrifice implies high rates of taxation. Hence, this principle recommends a high progressive tax structure. Edgeworth, Pigou and Musgrave propounded this principle of taxation and considered as the ultimate principle of taxation. The minimum sacrifice is the sole objective of this principle. Next, critics of subjective approach. First, the principle is completely dependent on the assumption the ability to pay is entirely dependent on the sacrifice of utility which cannot be measured in cardinal sense. Second, there is no definite evidence to prove that the marginal utility of money has an inverse relationship with the total income. Third, interpersonal comparison of utility is considered as unscientific, which is the basic criterion to prove this approach. Fourth, the measure of utility income cannot be always measured exactly with cardinal approach. Next is objective approach. The objective approach to the ability to pay principle focuses on the objective base of taxation which measures ability to pay accurately. Unlike subjective approach, income is not taken as a base here because an individual's income determines his command over resources, but it is a proven fact that the ability to pay does not increase in direct proportion to money income. Ability to pay increases more than proportionately to the amount of income. Another objective measure of ability to pay is wealth of an individual, which is also taken as a tax base. Savings from several previous years add up to an individual's wealth, which in turn determines how much resources a person holds. Therefore, wealth is considered a better index to compute the taxable capacity of an individual. More specifically, wealth and income together should be taken for the same for better measure from the viewpoint of ability to pay. Professor Kaldor states wealth and income to be an incomplete barometer for the same and instead proposed total disposable income or assets as a barometer to know the paying capacity of an individual. He also focused on another parameter, that is consumption, that is income minus savings. According to him, total income is not consumed by an individual. A part of it is consumed, which is taken out from the economic cycle for personal use, while on the other hand, the savings are reinvested in the economy as capital stock in the economy and therefore remains in the economic cycle. In other words, it is the expenditure tax both in developed and developing economies which should be considered as the true barometer to compute the tax payable capacity of an individual. Next, we will discuss the benefit received approach. The alternative approach to ability to pay is benefit received approach, which states that the taxes should be based on the benefit received rather than the income received, as those who receive higher benefits must pay accordingly. Example, people must pay for roads, for library patrons must pay for libraries, students must pay for education, etc. Critics of benefit received approach. First, the limitations of this approach are: it is difficult in its application. The true benefit received by an individual from the government is almost impossible to calculate. Example, the tax paid for education of a kid to government. The benefit cannot be computed in objective sense completely. Second, majorly the government expenditure is incurred on common invisible benefits which cannot be divided or apportioned equally between the individuals. Third, it is against the general objective of tax, which is not to pay against specific service but as a payment for the general purpose to the state. Fourth, it will indicate only how much tax revenue should be paid to the government, but this will not help us in dividing the tax liability amongst the individuals. Fifth, this principle can be easily applicable only in case where beneficiaries can be clearly identified. To summarize, benefit received approach can be used only to get the partial solution of the problem in fair and equitable distribution of tax liability. Let us now summarize what we have learned in this module. In conclusion of this paper, it can be said that taxes are a means of transferring the purchasing power of income from individuals to government. This in turn is used by government to provide public goods and services to the individuals. This ruling command is achieved through taxes. Income can be transferred by two main methods or bases of taxation: ability to pay or benefit received approach. Both the methods have their advantages and limitations. Ability to pay approach states that the people who have higher income must pay high and those with lesser income brackets must be relaxed with less tax burden. Income can also be substituted with sales, property and wealth, but all taxes are ultimately paid with income. On the other hand, benefit received approach focuses on the benefits received on which tax must be calculated. This approach is again criticized on various grounds. Hence, it may be said that it is better to levy taxes on various bases instead of a single base.